Okay, so this will demonstrate the critical key of using multiple time frames in your trading arsenal to increase your odds of success. Now, it's pretty easy to tell that this is a trend. And our swing point indicator shows you the series of higher highs and higher lows. But you come up to this point in time now where you start getting into a little sideways action. After you have a big move in the market, there can be a correction in one of two ways. If it's a time correction, that means that the price pretty much goes sideways for a period of time to allow the market to catch up with the move that it made. Or it can have a price pullback. If it has a pullback and you want to know what's the odds, how do you stack the odds in your favor? How do you give an edge so that you can trade with better success? Well, the key is knowing what the next higher time frame is. Well, let's show you what that next higher time frame is. We'll go to our next higher time frame and turn it on. Well, guess what? Now we see the next higher time frame is still in a long. So we decide to make an entry here. That's a very low risk entry. After this pullback, you have a double bottom. You make an entry there and you're back into the trend of the trade. Now you come along a little further and guess what? Oh, you have another pullback in price. Now, the odds say that the outcome will resolve in the direction of the higher time frame. Well, now you have it on the two shorter time frames. What's the next higher time frame say? Let's turn that one on. Okay, the next higher time frame, it still says that it's a long. So if you decided to continue trading that, there it goes, and sure enough, it went to the long side and continues to move up over quite some period of time. So that's the value. Now, if we turn on this the fourth time frame, and we turn on the 5 lines at the bottom, you'll see how that longest time frame was a green line all the way up for the entire time. And you can see how this indicator shows you that same kind of information, so you don't have to have all that on your charts. You can just work off of this indicator as well. So powerful tools are multiple time frame swing point. Now, how can you utilize that in actual trading? Well, here's a good example. Here is a confirmed upward trend from our swing point multiple time frame, and what we're looking for is every time our smooth price turns up and the line gets fat and bright green, that's the start of a confirmed trend for ADX. Those are good entry points after a red pullback and we get a green move. So you can see that's an entry point. Your stop loss would be very minimal. There's an entry point. Your stop loss would be just below that last spike downward. There's a possible entry point with your stop loss right below here or right below here. So you can see how that works for nice entry points back into the trend. Now, another way you can do that, again, we have our multiple time frame indicator here, and it's in a downtrend. In this case, we're actually using the shorter swings themselves for entry points. So we're getting in after the swing happens, and we get in on the other side into the trend. There, 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 there. And we see that the market starts bottoming, hitting multiple bottoms here. We decide to take our profits. Now, the third example is a Bollinger Band. Now we can take the extremes of the Bollinger Band. We could get in there on the extreme of a Bollinger Band, there on the extreme of a Bollinger Band, there, and there, all into this downtrend. So those are high probability trend trades, and how we can get into those trends knowing what the trend is. with our multiple time frame swing point and different tools to get into those trend entries. Now, extremely important to your trading success is proper position sizing and risk management. Position sizing on a $30,000 account with a maximum 1% of your capital at risk per trade equals $300. Now, that has nothing to do with what it costs to buy the stock. That means, in other words, if it were to hit your stop loss and you were to lose $300 on that stop loss, that's what you're going on here. Capital at risk, not the capital to make the purchase. So assuming that, let's use this for an example. We have a confirmed uptrend of the multiple time frame. We're looking for a low risk entry with a high probability of a high reward ratio profit. So here's an example. We basically had an upward trend. We had a pullback. We got into the entry here. Our stop loss was the yellow line right below the last swing low. And the trade worked its way up over multiple days. Exited when this brownish colored line is the trend line. When this broke down through that trend line, that was our signal to exit. The entry price was at 72.04. Our stop loss risk line was at 71.77. The initial capital at risk per share is 27 cents times the 1,000 shares equals $270 at risk. So that's why we could decide on 1,000 shares, because that only put $270 at risk. Now our exit was at 78.91 right here. A profit of $6.87 per share times the 1,000 shares equals $6,870. Our risk reward ratio, 27 cents compared to $6.87 per share, or 25.4 reward ratio. Now that's awesome. That's the key to profitable trading. Focusing on improving your risk reward ratio is the key to more profitable trading. Now, if you were to look at getting a 1-to-1 risk reward ratio, it takes 50% of your trades to break even. And we're ignoring commissions and slippage, so it would have to be just a couple percent higher than that. But basically, that's 50% on a 1-to-1. If you have a 2-to-1 risk reward ratio, that would be 34% for break even. A 1-to-3 risk reward ratio would take 25% for a break even. A 1-to-5 would take 17% to break even. A 1-to-25 would take 4% of your trades being winners to break even. This is why the percent winning idea, the number of percent, your entry system, and the high percentage of winners is such a fallacy. If you're trading a good trend system, the odds are you'll only make about 30% of your trades are going to be winners. But those can be huge winners. As you can see, if you're making these higher risk-reward ratios, it only takes anywhere from 4 at a 1-to-25 up to 17 at a 1-to-5 to make a break-even. So if you're trading those types of numbers and you're getting 30% of your trades are winners, you're losing 70%, but you're making a lot of money because of your risk-reward ratio. So that's why I say that information, you have to evaluate a strategy on much more than the percentage of winners. That's not taking into account market modes and the effect of a strategy and how it works with those market modes.